Hey guys, how are you doing? I hope you're doing great both physically and financially. My name is Rohit and welcome to Valuable Direction. The stock market has gone down and trying to rebound. A lot of high-flying and people's favorite stocks have crashed 60 to 80%. We know that stocks, especially Nasdaq, did enter a bear market and trying to recover. I'm sure a lot of you know it, but for others, bear market means the index or the stocks is down 20% from their recent highs. Now the big question is, if we are in a bear market, should we be buying stocks or wait? To get the answer, let's understand how to buy stocks with different investing styles and how beneficial they are in the long run. This is not a financial advice, but what I do and how I would like to execute my long-term buys. In addition to these investing strategies, I would also discuss what other consideration and strategies I would use to buy stocks so that the market noise don't panic me. I've broken down this video into two parts. The first part includes what are these simple investing styles are as per research and analysis, and in the second part, we're going to talk about various strategies, how to buy stocks by understanding various market conditions. So let's understand these investing or stock buying styles and know what benefits they could generate in 20 years. We all have faced times when the markets are at all-time highs and have crashed or did a correction or even entered a bear market. Most of us are unsure about when we should buy stocks. But before we get into details, a simple like button on the video helps the channel and promotes the video. So if you're enjoying, don't forget to smash the like button. Let me try to simplify these styles for you with some data. So here are our four investors, Adriana, Raghav, Apurva and UD. They picked up different investing styles and then following our research on their hypothetical long-term investing styles, their performances came out with surprising results. We could consider a benchmark that they invested $2,000 every year of their savings or bonus starting from the year 2000 to the next 20 years in S&P 500, which is an index that tracks the performance of the top 500 companies in the United States. So let's meet Adriana, who has incredible skills in investing and she understood market macro cycles. She does technical and fundamental analysis before buying stocks, and she's so good that every year she could perfectly time the market by buying at the lowest point of the year, like on September 21st, 2001. And then again next year, she timed the lowest level on SPY on 9th October 2002 and invested $2,000 again. She continued her superb timing all the way till 2020 and consistently using her insight of her analysis. Then there is Raghav, who followed simple investing technique by investing his $2,000 on the first day of the year in S&P 500. He didn't bother for the perfect timing in the market but put his money on the first day of every year. The third one is Apurva. She divided her $2,000 in 12 months. She actually used DCA or dollar cost average method, and she kept on buying with a set plan every month irrespective of the price. She found DCA more comfortable because she was getting extra money every month. Then our friend UD, who had such a bad luck or terrible timing that he bought at the top of the market. He invested his extra saved $2,000 at the highest level for S&P 500 like on Jan 30th, 2001, the next year on Jan 4th of 2002. So time for the results of their investment returns. To know the winner and the amount of hypothetical wealth they generated over 20 years, let's have a look at the data. The data actually comprises of 76 different periods of 20 years, and we will also find similar results across all periods. So our Adriana converted her $2,000 a year minimum investment to approximately $150,000 of wealth over 20 years. But the study's most interesting results came out for Raghav, who has come second with approximately $135,000. The difference between Adriana and Raghav is relatively small, which is just $15,000. Considering Raghav invested immediately as soon as he received the money. Apurva's DCA also performed nearly as well with approximately $134,000 at the end of 20 years. This is no surprise because in a 12-month period, markets move higher nearly 76% of the times. UD's results were also surprising and encouraging that with the worst timing, he could generate 3 times the gains, and just $14,300 short of Apurva is still way better than investing nothing at all. If one tried to analyze the data, going back to 1926, 66 of the 76 of the times, the results were similar. Adriana's gains were at the top with the perfect timing, followed by Raghav, who invested in one go for the year. The third spot went to Apurva with a dollar cost average, and the fourth went to UD even with a bad timing. Even in the other 10 periods of investing immediately like Raghav never came last. He made 10 to 12% of annual returns without breaking a sweat and investing just in an index of S&P 500. Important thing is, past performance is no guarantee of the future results. But with the research, if you cannot time the market, investing immediately and DCA is quite successful. The important thing to understand from this research is to devise a plan and dribble your investment evenly using that plan first. Like buying S&P 500 index is safer than tracking 500 individual stocks, but it is also important to understand that if invested with conviction using fundamental and technical analysis in a particular company, for example Tesla, an investor can generate significant returns. Now time for some consideration even with these investing styles and my personal opinion on them. So if you want to be surgical and time the market perfectly, which is not practically possible, the study suggests the benefits are not impressive even for the perfect timers. In the last 20 years, market had seen one of the best bull runs due to excessive monetary printing as well as innovation and efficiency of the businesses. But there were also times in the market where the market did not produce any significant returns for decades. Market was almost flat for about 17 years. But after these 17 years, market had a crazy bull run. You might witness the same past in the near future in the stock market after such a bull run due to tighter monetary policies by major central banks. Dollar cost average or DC is a good method if you are prone to regret, especially when large investments might have short-term drop. But if you are disciplined with your investments and add small amount as you earn, you can avoid procrastination. Because everyone fears some regret if your timing is not as expected and the market turns opposite for a short while. And if you're bad with timing the market, then doing multiple investment and none of them being large, you can always be a participant. Another thing with these data researches, they are carried out by buying S&P 500 index and not with individual stocks. We have seen that overall market goes up in the long term, but individual companies or stocks, if not researched, can cause complete loss of capital. They can also generate massive gains like Amazon, where a 20-year investment would give thousands of percentage of returns. There are times in the market where keeping cash on the sideline can be a good idea, especially when you're not trying to be surgical with the timing but focusing on some of the obvious negative catalysts to show positive change in the market sentiment, because that could generate more volatility for buying or show an inflection point towards the positive side. But it should be planned with a good understanding and without any regrets, because even if the opportunity is missed, that is basically an opportunity cost. Since we have three big catalysts in 2002 as discussed in the previous video, we have to be more educated and planned before going all in. Everyone has a different time horizon, but in the recent times, investors consider 3 to 5 years as a long time frame. But one needs to understand that there could be periods of bear market and stagflation, and as most analysts are predicting, there could be a recession in next 18 to 24 months. So make sure you really know what you are doing. Investing time frames of 10 years or above irons out a lot of market fluctuations. One has to be disciplined and put conviction in the market you want to invest. But don't put blind eye at the risk as well.
I want to get to treasuries because the market's getting a sign that a recession could be on the horizon. It's what everybody's talking about. The yield curve inverting after the closing bell. Right now, you're looking at the 10-year at 2.4, the 5-year at 2.5, and the 30-year.
Between the 2 and the 10-year, it turns negative sometimes before a recession, actually every time. Went as low as minus 0.3 of a basis point before it turned positive. Later, it now stands, what do we have now? 0.015 of a spread right now. So blink your eyes and it could be negative again. The inversion raises concern because it suggests the markets think the Fed will raise rates too high and too quickly, prompting a recession and then require an easing. That's why the longer end of the curve drops. The trouble is, recessions follow inversions anywhere from 6 months to 2 years later, so start your clocks now. Krishna Guha of Evercore ISI writing yesterday, we think the Fed will not ignore the 210 spread, but should not and will not be overly influenced by a mild inversion on this particular metric alone. He still expects the Fed to hike 50 basis points in the next 2 or 3 meetings and start reducing the balance sheet as well. The Fed, for its part, focuses on a different spread, the spread between the 3-month and the 2-year bond. It's massively positive at the moment, almost like the U.S. were in the middle of an expansion. What it reflects is an expectation of Fed rate hikes for at least the next 18 months. Now, this spread inverts 5 months closer to recession than the 210, or an average of 11 months.
In conclusion, we do understand, irrespective of your investing style, market will generate gains if you take calculative risk. It doesn't matter how much you buy stocks or indexes, but that you buy.
I don't know when to buy stocks but I know whether to buy stocks.
In the past 20 years, there were 3 recessions and 4 major crashes due to various world events. Still, the markets did what it's supposed to do, that is to go up, and produce gains about 10 to 15% annually just by investing in the stock market index. So in the first part, we have done the dissection of these simple investing styles and the wealth they can generate over a long-term investing time frames. I hope you got renewed insight into investing, and thanks for staying all this while, and do check the second part of this video on how to buy stocks, understanding new market and business dynamics, because times have come to master your finances by self-learning and good valuable direction. So keep up the good work. God bless you all. See you in the next one.